In this chapter, we will talk about merchandising companies. So far, we have been mostly discussing service companies which have a simpler operating cycle. Basically, they provide a service either on account or for cash. In this chapter, we will talk about merchandising companies which would involve also purchasing of inventory. So now we will be talking about inventory in this chapter. We will discuss the perpetual inventory system, as well as in the appendix we will also talk about the periodic inventory system. We will talk about recording purchases as well as sales, and we will also talk about about the differences between the accounting cycle for merchandising companies compared to service companies. At the end, we will talk about multiple step income statement. So basically, to start with, we need to identify or define what merchandising companies are. Basically, merchandising companies are the companies that sell goods, and they have to buy these goods in order to sell them. Their main line of business is sales, so their main revenue is sales revenue, and when they sell directly to the customer, those are retailers. When they and those people, for example, Office Depot, Walmart, etc., those are retailers. They buy from wholesalers and they sell to the customer or to the consumer directly. On the other hand, wholesalers are companies who sell the product to retailers. The accounting for both is the same, basically. With service companies, the cycle was much simpler. We used to in order to calculate the income, we used to list the service revenue and then subtract operating expenses to get to calculate net income or net loss. When we talk about merchandising companies, there is basically one step that is an additional one, and it is unique to merchandising companies. This is not, we don't see that for when we deal with service companies, and basically it's this part here. This part here is where we calculate the cost of the products that we are selling. So the cost of goods sold is an expense that that represents the cost of the products that we are selling. And basically, if we subtract the cost of goods sold from sales revenue, it will give us the gross profit. Now, this is, like we said, this is unique to merchandising companies, and this is what we will learn how to calculate in this chapter. And here, this is what we talked about. We have the operating cycle for service companies is very simple. We perform the service either cash, or let's say even if it were on account, so we perform service, and then it would be on account, we collect cash, and this is the whole thing. Here we have an additional step. This is an additional step. This is where we actually need to buy inventory in order to sell it. So basically, the company would buy inventory, then they would sell it to consumers or to customers in general, and they will get then accounts receivable, collect cash, and this is the operating cycle for merchandising companies. Now, companies report inventory under current assets, whether it was a merchandising company, a retailer, or a wholesaler. They always report inventory under current assets. And companies, they would use either a perpetual inventory system or a periodic inventory system. Now, the flow of costs for inventory, this is how we usually calculate the ending inventory. Basically, we start with the beginning. Basically, we start with the beginning balance. So beginning inventory, then we add the purchases, that would give us the goods available for sale. And then we subtract the goods sold to get to the ending inventory. So let's try now an example with some numbers here. So for example, let's say that we had for a beginning inventory, we had 100 units. For example, let's make it easier. We had 100 TVs. So we started off with 100 TVs, and then during the accounting period we bought 500 TVs. Now the goods that we have in our store and that we can sell at this point is 600 TVs. So basically we have in our store 600 TVs that we can sell. Let's say that during the year we sold 300 TVs. What would the ending inventory be? At the end of this accounting period, we will know that we will end up with 300 TVs. Now let's replace TVs by the cost of the TVs. So let's replace the TVs by the cost of the TVs. Let's say that instead of saying 100 TVs, we started off with, and let's say each TV is $500, so we started off with 50. That's 100 TVs and $50,000. We added during the year purchases, that would be $250,000. We end up with 300,000. If we sold 300 TVs, that's 150,000. We will end up with an ending inventory for the value of $150,000. That would be the ending inventory. And this is what we see here. We have the beginning balance, you add to it the beginning inventory balance, you add to it the cost of the goods that you purchased. This will give us the cost of goods available for sale. And then we subtract the cost of the goods that we have sold, which would give us eventually the ending inventory. As we mentioned, most companies, they use either a perpetual inventory system or a periodic inventory system. Basically, the difference between the two is in the way they calculate, or when they calculate the cost of goods sold. With perpetual systems, companies, they first, after every transaction, after every sales, they calculate how much inventory they still have on hand, and at the same time they recognize the cost of goods sold. Basically, they calculate how the changes to the cost of goods sold and to the inventory after every sale. On the other hand, with periodic systems, companies, they don't calculate, or they don't take into account the changes to the inventory until the end of the accounting period. Once they reach the end of the accounting period, they conduct a physical count, and then that would give them the ending inventory. After that, they subtract it from the goods available for sale, which would give them the cost of goods sold. So with perpetual system, it's done perpetually or continually, and that which by that we mean calculating the inventory and the cost of goods sold is done perpetually after every sales transaction. On the other hand, with periodic inventory systems, it's only done periodically at the end of the accounting period, where the total count of the ending inventory is the ending inventory is counted, and then it's subtracted from the cost of goods available for sale to determine the cost of goods sold, which the company is supposed to recognize as expense. Now, this is like we mentioned before, so this explains the difference between the ending inventory, between the periodic system and the perpetual system. With the perpetual system, after every sale, so this is, we record this is an inventory purchased, we calculate the revenue, and we also look at the cost of goods sold. At the end of the accounting period, we don't need to make an entry for inventory. For periodic systems, it's the other way around. The company does not calculate here any cost of goods sold or inventory balance after every transaction. However, at the end of the accounting period, they calculate the cost of goods sold by determining by conducting a physical count of the inventory and subtracting that from cost of goods available for sale. Under the perpetual inventory system, the companies, they would record the changes in inventory. For example, when the purchases in inventory by debiting inventory, which is an asset account, and by debiting them they increase it. So purchases increase inventory, and if the company purchases the inventory using cash, it will decrease cash, or it will increase a liability. We have also expenses associated with freight. We have also purchase returns, purchase discounts, purchase allowances. Those are so purchase returns and allowances, as well as purchase discounts, are included directly into the inventory account. On the other hand, for sales, every time we have a sale, the company would recognize the sales revenue, which would increase either cash or an accounts receivable if the sale was made on account. At the same time, the company calculates the cost of goods sold, which increases as well, while the inventory account decreases. And that is done after every sales transaction. Now, under the periodic system, the companies, like we mentioned, they don't keep track of every of the inventory or cost of goods sold after every transaction. They wait until the end of the accounting period, and then they do it in the same way that we explained before. So they start with beginning inventory, they add the purchases net, and by net we mean this is after excluding purchase returns and purchase discounts. Then that would give us the goods available for sale. We subtract the ending inventory, which the company can identify by conducting a physical count, and then that would give us the cost of goods sold, which needs to go on the income statement. Well, it is important to say that the perpetual system is not as prevalent as periodic system for several reasons. One of the most important reasons is the cost. It is much more costly and much more complicated to keep track of inventory and cost of goods sold after every sales transaction. This is why many companies, they don't find it cost beneficial to them. As a result, they use the periodic system. Now, however, the perpetual system, they do provide additional information. For example, management can know at any moment how much, let's say Walmart, they can know at any moment how many blue jeans size 30 of a certain brand they have they have in their warehouses, so they can know at every time the amount of inventory that they have. At the same time, they know how much it costs. But like we said, it will require additional work. With the use of computerized systems, many companies they have they are able to use perpetual system. However, it's still not as prevalent as periodic. And it has, however, like we said, it provides a better control over inventories, because the companies at that point can simply what the companies can do is, if any theft or any differences in numbers are detected, the companies can act on it directly. And because of this cost, usually companies they use perpetual, like companies who use this one are companies that deal with high unit values, such as cars or trucks, or expensive products such as projectors, etc. And now, one more thing to say is that even companies who use perpetual systems, they do still conduct an end of accounting period physical count, and that is simply for control and monitoring purposes. Basically, they don't really need to conduct it because they are calculating the cost of goods sold and the amount of inventory on hand after every sales transaction. However, to make sure that they actually have the same numbers, that there was no employee theft or shoplifting or any additional damages that were unaccounted for, companies who use a perpetual system, they would conduct a physical count of inventory at the end of the accounting period to cross verify or to double check the numbers that they have on the company's accounting systems. Now we will start talking about how merchandising companies record purchases. Usually they start off with an invoice. So any purchase can either be made on using cash or on account, and in many cases the companies they just use the sales invoice that the seller sends to the buyer. At this point, the sales invoice can be used as a as a replacement of purchase invoice, and that invoice usually it would include the name of the seller, the name of the buyer, as well as other information needed for related to the buyer. It includes the date of the transaction, salesperson, the terms of sale, as well as the terms of shipping, who's gonna pay for shipping. We'll talk about these items in detail. It has also information on the specific products and the total amount that is that the buyer will be billed. So let's start with an example. In this example here, we have the buyer, Sauk Stereo, uses a purchase invoice, the sales as sales invoice, the invoice that the seller sent them. Seller is PW Audio Supply, and the journal entry for this one, here we need to make the journal entry for the buyer. Now, when the buyer buys or purchases inventory, what happens to inventory? Let's think about it in this way. In this case, the terms here, they say that it is on account. It's not cash. As a result, the buyer's inventory account, which is an asset, will increase. Now they have additional inventory. So their inventory will increase by for the value of 3,800. So we debit inventory 3,800, and we credit accounts payable 3,800, because it was purchased on account, which is to mean now this is an additional liability. This is and accounts payable. The liability accounts payable will increased by 3,800. As a result, we credited 3,800. Now we will talk here about the term of with regards to the term of sales. We talk about the sales, the shipping, and who's going to pay for shipping. As you can see from this here, it says free on FOB shipping point. FOB shipping point means free on board shipping point. That is to mean it is free to put on board of the truck for the shipping point, and the shipping point is the seller. So it is free shipping for the seller. As a result, the party who will be paying for the shipping is the buyer. So when you say free on board shipping point, the buyer will be paying for the shipping or for freight expenses, for the freight cost. Now, when it is FOB destination, it means that it is free on board for the destination party, and that would be the buyer, which is to mean the seller will be paying for the freight costs. Now, who owns the product or the goods when they are on the truck, when they are being shipped from the seller to the buyer? Actually, the party that pays for the shipping will be the party who owns the goods on the carrier, on the truck, on the delivery truck. So in this case, the ownership passes at this point here. From this point on, it is the buyer's property. When the shipping is paid by the seller, ownership passes once it's delivered. Think about it as Amazon Prime, for example. When you buy something from Amazon, if Amazon is paying for the shipping, it's still Amazon's property until it is delivered to your house. On the other hand, if you pay for shipping, the product is yours as soon as it is on board of the truck. Now, there's a difference here. The main difference, an important difference here between the two is how the two parties would recognize this shipping cost. So the freight cost for the seller are an operating expense. It's called freight out or delivery expense. So when the seller pays for the shipment, the seller records it as an operating expense. And the reason is that to do that is that the seller is actually will have to pay this in order to make the sales transaction happen. On the other hand, when the buyer is paying for the shipping, it simply is added to the cost of inventory. Remember that the inventory is an asset, and assets are recorded at cost. This is, as we mentioned in a previous chapter, this is the cost principle. So inventory is recorded at cost, and cost is not only the purchase price, it's actually whatever the company pays for the product to reach their warehouses and until the product is ready for sale. So basically, the shipping is included in the cost of inventory, and as a result, it will be directly added to the inventory account. So the difference between recording freight charges when it is paid by the buyer, which is to mean it's a free on board shipping point, and when it is paid by the seller, i.e. it's free on board destination, the difference is the way how they record it. Now, as far as the buyer is concerned, let's assume upon delivery of the goods that Sauk Stereo, who is the buyer, paid the $150 for freight charges in cash. So the journal entry for this one will be added to the cost of the inventory, and that would be paid in cash. So we debit inventory and we credit cash. The idea here is that inventory is recorded at cost, and this is not just the purchase price, it's actually the cost until the inventory reaches the warehouse of the basically until it reaches the store of the buyer. So originally it was, this is inventory account when the buyer purchased value for 3,800, and then that was the purchase, and then they also paid 150, that is shipping. So the freight charges were added to the cost of inventory. So until this moment, the cost of inventory, the balance will be 3,950. On the other hand, when it is paid by the seller, that's the second scenario here. So here it's paid by the buyer. Here it's paid by the seller. At this point, this is an operating expense that the seller has to endure in order to make this sales, for example. So at this point, it is an operating expense that is called freight out. So we debit the expense, freight out or delivery expense, and then we credit cash. The difference here, like we said, it's in the account that is used. For the buyer, it is added to the cost of the inventory. It is part of the cost of the inventory, whereas for the seller, it is not part of the revenue. It does not. It has nothing. It's not their revenue. It's actually an expense, an operating expense that the seller incurs to conduct their business. The other, now that we have studied about purchases and basically how to record the purchase itself and the shipping cost. In many cases, if the buyer is not satisfied with for any reason, is not satisfied with the goods, or they found that they had a problem, they didn't like them, they have the right to return. They can return part of the inventory. At this point, they will either, so the seller at this point will either issue a full refund, for a full return. At that point, the buyer will return this, return the damage or the defective product for a full refund. That would be purchase return. The other at that point, the seller will have to give them back their money, or if it was payable, it will decrease their liability, the buyer's liability. On the other hand, sometimes the seller would offer the buyer to keep the products. However, they will give them an allowance. Basically, they will decrease or they deduct part of the selling price. At this point, rather, for example, if you had, let's say you buy a TV from Best Buy and you find out that it was dented, or that the pixel, there was a dead pixel, you have the right to return it. Now, Best Buy would have one of two options. The first option would be to take back the damaged goods, or take back that damaged TV, and then they would issue you a refund. The other option would be to tell you, for example, okay, so you bought it for $500. Would you like to keep it as is for $450? Well, it depends on the buyer at that point. If the buyer accepts this allowance, they get to keep the TV at a lower purchase price. And this is what you call here purchase allowance. Now, how do we record these transactions? So assume that on May 8th, Sauk Stereo, that's the buyer, returned to PW Audio Supply goods costing $300. What's the journal entry here? Now, Sauk Stereo will be returning part of the inventory, which is to mean their inventory will decrease. At this point, how do you inventory, which is which is an asset account. It has a debit balance, so how do we decrease it? We credit it. But at the same time, now Sauk Stereo, who is the buyer, owes the seller $300 less. As a result, their liability will decrease by $300. So we debit accounts payable $300 and we credit inventory $300. So as a result, the account would be, so far, inventory account will be 3,800. That was the purchase. 150, that's the shipping. And then we credited the account 300 for the returns. Another thing that happens when purchases take place is that sometimes the seller would offer the buyer a certain discount if they pay within a specific period of time. As you remember from the sales invoice, the terms of sale said 2, 10, and 30. So this 2, 10, and 30 is actually red. This one is actually red. 210 net 30, which is to mean if the buyer pays their debt within 10 days, they get a 2% discount. Otherwise, they will have to pay the net amount within 30 days. And by net amount, we mean the original purchase minus any returns or allowances. Now, this has advantages to both the seller as well as the buyer. The seller will get the chance to shorten their operating cycle, and by that we mean like they get their money back faster. And on the other hand, the purchaser, they will be saving money, because if they pay within 10 days, that would make it a lot cheaper for them. They gain 2% from the sale. So let's see how we record purchase discounts. But before that, we have let's see what kind of purchase discounts usually are usually common. So the first one is, for example, when it says 210 and 30. This means it's 2% if the amount is paid within 10 days, and otherwise the net amount has to be paid within 30 days. So it's 210 net 30. It could also be 110 EOM, that's end of month, which is to mean the buyer will get a 1% discount if it was paid within 10 days of the next month. It could also be net 10 EOM. It means that the full amount, or the net amount, has to be paid within 10 days of the basically within the first 10 days of the next month. And this is usually it usually shows on the sales invoice. As you remember, we had in our example, we had this one 210 net 30. So let's see how this is recorded. If Sauk Stereo failed to take the discount and instead made the full payment of 3,500, this is the 3,800 minus the returns. As you can see here, the $150 shipping has nothing to do with the sale with the seller. So that was paid directly to the carrier company, to the shipping company. It has nothing to do with the seller. So as far as the seller is concerned, it used to be 3,800 minus 300, which was the return. So let's say that the buyer, Sauk Stereo, did not pay the amount within 10 days. As a result, they are not entitled to any discounts. The amount that they have to pay will be the 3,500. So at this point, we debit accounts payable and we credit cash. And because they are settling their debt at this point, they don't owe the seller anything anymore. This is why it's we debit accounts payable 3,500, because it's going to be settled. Now let's say, on the other hand, if they actually were able to pay within the accounting period. So let's say that at that point they are entitled to 2% discount. Now the discount is always on the net amount. It's not on the original amount, because you don't get discounts on the products that you have returned. So as a result, the net amount is 3,500. That's 3,800 minus 300. The journal entry here will be, first of all, the debt was 3,500, and that debt will be settled. That was the accounts payable. It was 3,500. So now we debit accounts payable 3,500. This one does not change, because this is the amount that was on the books. This is the amount of the liability that we owed, that basically Sauk Stereo owed the seller. Now, Sauk Stereo, because they are entitled to a discount, what they will do is they will pay the amount 3,500 minus the discount. The discount is 2%, so this is 2% multiplied by 3,500, which is equal to 70. So the discount is $70, which is to mean that the amount that Sauk Stereo has to actually pay, the cash amount will be, so the cash will be 3,500 minus 70, and that is 3,430. The difference between the two is credited to inventory. And why do we do that? The reason why we do that is that the cost of the inventory to Sauk Stereo, now it's not 3,500 plus the 150 shipping. It is now, and remember that inventory is recorded at cost. So the cost of inventory now is 3,430 plus the shipping. So this is why we credit it to inventory, in order to decrease it by the amount of this discount. So the discount is decreasing the cost of the inventory. As a result, we credit it to inventory. And this one just shows like why would the purchaser or the buyer actually take advantage of it. It simply says that if the buyer was to take advantage of this discount offer and actually paid it within the discount period, it's as if they are having basically they would be saving over $50, because if they have, for example, if they take a loan from the bank, it would be equivalent to a loan from the bank for the amount of 36.5% annual rate, which is much higher than the bank's rate. At this point, it would be more basically more beneficial to the buyer to even take a loan from the bank and pay this amount within the discount period, because they will be still saving basically a huge amount of money. This one is a summary of all the purchasing transactions. This was the original purchase plus the freight in, this was plus the shipping cost. They were debited to inventory, and then we credited returns and discount. So this is the value, this is the balance in the inventory account. So on September 5th, De La Hoya Company buys merchandise on account from Diaz Company. The selling price of the goods is $1,500 and the cost to Diaz Company was $800. On September 8th, De La Hoya returns defective goods with a selling price of $200. We need to record the transactions on the books of De La Hoya, and De La Hoya is the buyer. So here we are making the journal entry for the buyer. First of all, when they purchased the merchandise on December 5th, they purchased the merchandise for $1,500. So basically, on the 5th, their inventory has increased, and because they purchased it on account, we debited inventory 1500 and we credited accounts payable 1500. Now on September 8th, De La Hoya returned certain defective goods for the value of 200. At that point, we need to decrease the liability, accounts payable, and to decrease inventory account. So we debit accounts payable 200 and we credit inventory 200. This cost here, this is for the seller. The buyer is not concerned with this amount. So this is why we did not include it in our calculations. So this is for the seller. This concludes the part of purchasing, of recording purchases for merchandising companies. Now we get to recording the sales of inventory and sales of merchandise. So far we have been looking at the purchase side of it. Now we will look at the sales side, or at the seller's perspective. So here we will be using the same sales invoice that we used to record the purchase. And once again, it has the same information. It has the seller, it has the buyer's information, the terms of sale, it has the shipping terms, as well as the date, and of course, what products were purchased. So, under the perpetual inventory system, remember this is the perpetual system. Under the perpetual system, the seller has to make 2 journal entries after every sale, and this is the first one will be to record or recognize the revenue. So this one is to recognize the sales revenue. The second journal entry is to record the changes in inventory and to calculate the cost of goods sold. So this is here to record changes to inventory. The first one, we use the selling price. This is whatever is on the sales invoice. This is the amount that was that the buyer is going to pay the seller for in return for the merchandise. It could be, so the first journal entry would be to debit cash or accounts receivable if it was made on account, and to credit sales revenue. On the other hand, the second journal entry, because the inventory for the seller, the inventory will decrease, so inventory is credited, and the cost of goods sold is the expense. So this is the cost of the inventory that was sold. This is the cost, this is an expense that the seller has to recognize. As a result, it is debited the same amount as cost. This is based on the cost price, not just the price, the cost. That would be the cost of buying the inventory, not the selling price. So this is cost of acquiring inventory for the seller. So let's look at this example. Assume PW Audio Supply records its May 4th sale of 3,800, which was made on account. Once again, whenever they're under the perpetual system, we always, the seller will always make 2 journal entries. The first one is to recognize the revenue, and the second one is to recognize the expenses associated with that sale or with that revenue. So at this point, the first journal entry would be, because it's on account, so accounts receivable is debited 3,800 and sales revenue is credited 3,800. The second journal entry will be to recognize the cost associated with this sale, the cost of goods sold associated with this sale. This is the expense that will match or follow the revenue. This is the matching principle, or the expenses recognition principle, where expenses will follow the revenues. Here we are told that the cost of the inventory to the seller, to PW Audio Supply, is 2,400. As a result, cost of goods sold will be debited 2,400 and the inventory will have decreased by 2,400. This one is to recognize the revenue, and this one is for the expense. This one is for the expense. Once again, now this is the flip side of, this is the other side of the story. This is the flip side of the purchase returns and allowances. Here, what the buyer's return, purchases return and allowances will be the seller's sales returns and allowances. However, with the buyer, we directly made the changes to inventory. However, with the selling companies, they don't like to mess with the sales revenues. They don't touch the sales revenues. As a result, they use a contra revenue account that is called sales returns and allowances. And the reason why they do that is that they want to keep track of the portion or of the part of the sales that was returned. Because, for example, if you have excessive returns, it means that you may have a problem with the product quality. It may be a problem with the shipping process. You could be delivering to the wrong address, etc. So you have high return rate. At that point, management might decide to intervene, or at least to basically address that issue. This is why sales revenues are not directly affected as a result, but we use a contra revenue account that is called sales returns and revenue and allowances. So here, this is how we make the journal entry. So we need to prepare the entry for the $300 return, and here we assume that the cost is $140. Once again, because this is affecting more or less the sales of products, the seller will have to make two journal entries. The first one is to record the returns of the sales, and the second one to record the changes again in inventory and the cost of goods sold. Here we are assuming that the goods were not defective and that the cost was $140. So as far as the first one is the first journal entry is concerned, $300 worth of products were returned, and because it was purchased on credit, so accounts receivable will be credited the $300, and sales return and allowances, this is the contra revenue account, will be debited $300. So we don't directly debit revenue, we debit a contra revenue account, which is sales returns and allowances. And then, in order to, because the buyer has returned some of the inventory back, so this inventory will be added back to the inventory account. So the inventory will have increased again by 140. So we debit inventory by 140. Remember that inventory was recorded at cost and not at the selling price. So this is the cost. This is the one that will be used for inventory, whereas this is the selling price. This one is used for the contra revenue account and accounts receivable. and we debit inventory 140 and we credit cost of goods sold 140. Here what we're saying is that we made basically we returned part of the sales, so it's as if it did not happen. We have more inventory now by 140 and we have less expenses. Now let's say that the returned goods were defective and they had a scrap value of $50. The first journal entry, this is still, it has to do with selling price. So this is not affected. It's the same journal entry as before. But the second one, the value of the inventory, rather than being $140, at this point it is only debited $50 and cost of goods sold is credited $50. This is the fair value of the returned goods. To summarize sales how to get to net sales. Now, before that, we need to talk about the sales discount. So the sales discounts are again the flip side of the purchase discount. The sales discount is also a contra revenue account, and this is again based on the terms of sale. It's like 210, net 30, etc. Companies are interested in knowing the net sales. So you start off with the sales revenue, and as you remember, revenue is a credit, it has a credit balance, so it was credited. And then we have the contra revenue accounts, which have debit balances, and as a result, so they have debit balances, and we have net sales. So here we know that net sales is equal to sales revenue minus sales returns and allowances minus sales discounts. So it is 3,800 minus 300 minus 70, and that would be net sales. So assume South Stereo pays the balance due within the discount period. So this was the last day of the discount period. We need to prepare the journal entry from for the seller for PW Audio Supply. Now on that day, again, the discounts are on the net amount, which was 3,500. Accounts receivable was recorded at 3,500. So we know that we'll have to decrease accounts receivable by 3,500. As a result, accounts receivable will be credited 3,500. On the other hand, the buyer, South Stereo, will be paying the full the amount, the 3,500 minus the discount. The discount was $70, 2% of, so the discount is 2% multiplied by 3,500, it's equal to 70. This is the discount. And as a result, cash, the seller will receive cash 3,430, which is 3,500 minus 70. So cash is debited 3,430. Sales discounts is debited 70, and accounts receivable will be credited 3,500. This is, if you remember, this was the purchaser's side of it. Accounts payable was debited the full amount to decrease accounts payable, and then we credited cash and inventory $70. Here we have, for the sales discounts, the journal entry for the sales discounts, you will debit cash, the net amount minus the discount, and then you will debit the sales discount and credit accounts receivable the full amount. Now, after finishing the journal entries, here we will talk about adjusting entries. This is basically the same as as the adjusting entries for service revenues. However, we also make one additional adjusting entry that would be for the inventory and the cost of goods sold. The unadjusted balance in inventory, it can be different from the inventory on hand. That could happen for so many reasons. So basically, a lot of companies at the end of the accounting period, even if they are using perpetual inventory system, they also conduct a physical inventory count for control and monitoring purposes to see if someone has stolen, for example, shoplifting, damaged material, damaged inventory, or for example, if there was any theft from the employees. As a result, the company has to make one adjusting entry to adjust the company's books. This is whatever, this is based on the journal entries that they made throughout the year after each sale. This is what we have been doing so far. And to adjust that amount to reflect the physical count of inventory. So PW Audio Supply have an unadjusted balance of $40,500 in merchandise inventory. So this is depending on the company's records. The unadjusted balance is $40,500. According to the physical count, the value is $40,000, which is to mean there is a difference of $500 between the company's records or the unadjusted balance and the actual physical count. As a result, the company would need to make a journal entry to adjust for the difference between the two. And this is basically the company would debit cost of goods sold $500 and would credit inventory $500. This is basically saying that the company's assets have decreased and the stockholders' equity has also increased due to this expense and the difference in cost of goods sold. And finally, we get to closing entries. The closing entries is the same concept for merchandising companies as and service companies. So basically, we have to close temporary accounts, which are revenues and expenses, to income summary, and then we close income summary to retained earnings, as well as dividends to retained earnings. So here we start by debiting credit accounts, that's the sales revenue. In order to close a credit account, we debit it. So we debit sales revenue, we credit income summary, and then we credit debit account. So this is a contra revenue account. This one too is a contra revenue account. So those are contra revenue. So this one is different from sales from service companies. This one as well, cost of goods sold, freight out. The remaining operating expenses are treated in the same way. So here we are crediting expense accounts as well as contra revenue accounts. The last two are where we close income summary to retained earnings, and dividends to retained earnings are the same as service revenues. They are the same as service companies. So here, let's look at this one. The trial balance of Celine's sportswear shop at December 31st shows inventory 25,000. So we have the list of accounts and we need to prepare the closing entries. We start by looking at the credit temporary accounts. So at the temporary accounts that have a credit balance, we have sales revenue and we have rent revenue. So we debit sales revenue 162,400. We debit rent revenue 6,000, and we credit income summary the sum of the two numbers. Then we get to the accounts that usually have a debit balance, the temporary accounts that have a debit balance, and we credit them. So first we start by debiting income summary, the total amount, and then we credit individual accounts. Now here, inventory is not a temporary account, so we don't include it. This is not a temporary account. It's a permanent account, so we don't close it. But we have also sales returns, so we start crediting sales returns, and we start crediting the other accounts. So for example, you have cost of goods sold, we have sales returns and allowances, we have we have cost of goods sold, sales returns and allowances, we have sales discounts, we have freight out, we have rent expense, salaries and wages expense. Now, in order to prepare the income statement, so far we have been using basically a simple income statement where we would put all the revenues and then we list all the expenses and we subtract the expenses from revenues to determine net income or net loss. Now, companies sometimes they also prefer to use especially merchandising companies, they would prefer to use multiple step income statement. And the multiple step income statement basically shows the difference between operating and non-operating activities. So whether you have expenses from operating activities or for example expenses from non-operating activities, it will show the difference between the two. And it has basically more information, so it takes into consideration, it shows the cost of goods sold, and it is done in several steps. So the first thing, when we start writing or preparing an income statement, a multiple step income statement, the first thing to calculate is the net sale. So the net sales are simply the sales revenue less the contra revenue accounts. Those are the sales returns and allowances and sales discounts. So we get to the sales revenue, the net sales. And then companies would include after that the cost of goods sold. The difference between net sales and the cost of goods sold will give us the gross profit. This is basically, it gives us the information on the merchandising profit. This is not the overall profitability of the company. This is because we have not taken into consideration operating expenses yet. We did not include, for example, salaries expense, or basically we did not take into consideration salaries expense, rent expenses, etc. Here we are only taking into consideration the cost of the inventory that we have already sold. So the gross profit would be 144,000. This is the difference between the net sales, 460,000, and the cost of goods sold, which is 316,000. Now, because this is an absolute number, it may not be very informative to basically to compare. So if we say, some people might look at this one and say, oh, okay, so the gross profit is not that beneficial, it's not that big, it's just 144,000, so this is not impressive. On the other hand, if you talk about a company that has a gross profit of $100 million, now that would be more impressive. But this is not the whole story. This is not the full picture. The complete picture would take into consideration the amount of net sales. So the people sometimes they prefer to use the gross profit rate because it tells how many cents of each sales dollar go to gross profit. So in this case, just to calculate this one here, you divide the gross profit by net sales. And for this company, for PW Audio Supply, it's 31.3%, which is to mean for every dollar of net sales, the company's gross profit is 31.3 cents. So this one, let's say that, let's go back to the other example where we said it was $100 million. If it was the gross profit 100 million, but the net sales were 1 billion. If it were 1 billion, at this point, the gross profit rate would be 10%. So when you look at the two of them, which one is more, which one has a higher gross profit rate? It's PW Audio Supply. It has 31.3% gross profit rate. So in order to calculate the gross profit rate, first we need to calculate the gross profit, which is the difference between, which is net sales minus cost of goods sold, and then you divide it by the net sales. That would give you the gross profit rate. So just to summarize it, gross profit rate is equal to gross profit over net sales, which is equal to net sales minus cost of goods sold over net sales. And if you want to break it down even further, that would be sales revenue minus sales returns and allowances minus sales discounts, that to replace net sales. After that, on the income statement we'll list the operating expenses. Those are the same operating expenses that we have listed in the previous chapter, which would include salaries and wages expenses, advertising expenses, interest expense, etc., etc., depreciation and others. And that would give us the total operating expense. So this is the total operating expense. Now from the gross profit, you subtract the total operating expenses, and that gives you the income from operations. So this is the income from the main business activities of the company. It's called income from operations, and that this is equal to gross profit minus operating expenses, minus total operating expenses. Companies after that list non-operating activities, which would include other revenues and gains and other expenses and losses. Those are not from the main business activities of the company. That could be, for example, interest revenue. For instance, Best Buy, while they have service revenues, this is the Geek Squad, when they provide services to fix electronics, etc. And they also have sales revenues, which is from the sales of products. But they also sometimes offer financing services to, for example, if you want to buy a computer and finance it, at that point, if you don't pay on time, they will start charging you interest. Now this is interest revenue, but it's not from the main line of business. As a result, it is listed under other revenues and gains. Also, there is, when you make, like for example, if you had a truck and you sell it, or other equipment or a building where you sell it and you make some profits from the sale, this is listed under gain on disposal of plant assets. If it was a loss, it would be loss on disposal of plant assets. If it was an interest expense, it would be under other expense and losses. And basically, this is a list of this is the main list of other revenues and gains. It would include interest revenue, dividend revenue. This is the dividend that PW Audio Supply gets from investing in another company. And then you have also rent revenue if they are renting or subleasing part of their warehouses. You have gains from the sale of property, plant and equipment. Other expenses and losses, you have interest expense. This is when the company is paying expenses, or you can have maybe damages, like for example casualty losses. Some people are breaking your equipment, etc. Or loss from sale or disposal of property, plant and equipment, etc. Now, once we have all this information from the income from operations, you add other revenues and expenses, and you subtract other expenses and losses, and you end up with the company's net income or net loss. This is the multiple step this is the multiple step income statement compared to the one that we did before. Now, in contrast to the multiple step income statement, where we have grouped similar expenses together and similar revenues together, when we use the single step income statement, basically we dump all the revenues in one place and then we dump all the expenses, and then we subtract total expenses from total revenues. And people sometimes they use this one because first of all it's much easier, it's simpler, and whenever companies they don't see any benefit from using a more complicated multiple step format for the income statement. So that happens mostly when the company only realizes profits, etc., when their total revenues are greater than their total expenses. And this is how it would basically look like. You have all the revenues are listed together, then all the expenses are listed together. So we have revenues, this is total revenues, we have total expenses, we subtract, and then we get to the net income. For the classified balance sheet for merchandising companies, it's the same as service companies, with the difference that we have also the inventory account, which is listed under current assets, and it is usually listed right after accounts receivable. And because you need to sell the inventory, usually if you sell it on account, it becomes an accounts receivable, and then you need to collect accounts receivable. As you remember, current assets are listed in the order of liquidity, or in the order they are expected to be turned into cash or used up. Here we just need to see how how each one is classified and under which financial statement. So for example, accounts payable, it goes on the financial on which financial statement? Accounts payable goes on the balance sheet under current liabilities. Accounts receivable goes on the balance sheet under current assets. Accumulated depreciation for buildings goes on the balance sheet under PPE. Accumulated depreciation equipment, same thing. Advertising expenses, it goes on the income statement under operating expenses, and here we're talking about the multiple step income statement. Buildings, it goes on the balance sheet under PPE. Cash, balance sheet, current assets. Common stock, balance sheet. Stockholders' equity. Depreciation expense, that's an expense. It goes on the income statement under operating expenses. Dividends, and this is the dividend that the company is paying out to their shareholders. It goes on the retained earnings statement as under the deduction section. This is where we say less dividends. Equipment on it goes to the balance sheet under PPE. Freight out, this is the expense. It's on the income statement, it's an operating expense. Gain on disposal of plant assets, it goes on the income statement under other revenues and gains. Interest expense, income statement, operating expenses. Interest expense, again, income statement, other expenses and losses. Interest payable, now this is a balance sheet, it's a liability, so goes under current liabilities. Inventory, it's a current asset, so it goes on the balance sheet under current assets. Land, it's balance sheet, PPE. I have notes payable, this goes under balance sheet, long-term liabilities. And this is not notes payable, and there's one part which is called sometimes maturities on long-term liabilities. Those are the ones that you will have to pay this year. So although it was originally a long-term debt, however, it is maturing now. This is not the same as notes payable. Notes payable usually are long-term liabilities. We'll talk into more detail about this in future chapters. Property taxes payable. This is balance sheet, current liabilities. You expect to have to pay the taxes within 1 year. Salaries and wages expense, income statement, operating expenses, salaries and wages payable, balance sheet, current liabilities, sales returns and allowances. This is a contra revenue account, so it goes on the income statement and under sales revenue. As you remember, we put less sales returns and allowances. Sales revenue is income statement sales revenue. Utilities expense. This is income statement operating expenses. Now, so far we have been talking about the perpetual inventory system. Here we will talk about the differences between perpetual inventory system and the periodic inventory system. Like we said, for the perpetual system, the companies would record the revenues every time the sales is made, but at the same time they have a second journal entry to record the changes to inventory and to calculate the cost of goods sold. With periodic inventory systems, companies, they only record their revenues, but they do not calculate the cost of goods sold. Instead, they wait until the end of the accounting period. They physically count the inventory, and they do that in order to see the ending inventory, or that would be the inventory on hand. So this is the ending inventory, and that would also be the balance of the inventory account. And at the same time, they also conduct this physical inventory count to calculate the cost of goods sold during that period. Instead of debiting and crediting inventory like we did for purchases, instead of debiting and crediting inventory like we did with the perpetual system, companies that use periodic inventory system, they debit and credit individual accounts such as purchases, purchase returns, purchase discounts, etc. So let's see how this works. This is how the cost of goods sold is calculated. So how do you calculate the cost of goods sold? You have the beginning inventory. So basically we have beginning inventory, and then you add purchases. This is whatever the company purchased, whatever inventory the company purchased during that year. And then you subtract returns, and you subtract discounts. Purchased returns and purchase discounts. These would give you what is called net purchases. So this is the net purchases. Once you have the net purchases, you add the shipping, you add freight in. And then that would be the cost of goods. This one will give you the cost of goods purchased. So this is the cost of goods purchased. Now, when you add this whole thing, that would be the cost of goods available for sale. Basically what you did, you started off with the beginning inventory here, you added purchases and you subtracted purchase returns and allowances, and then you got to the net purchases. To the net purchases here, we added the cost of the shipping, and that gave us the cost of goods purchased. So we added, eventually we added inventory plus the cost of goods purchased, and that gave us the cost of goods available for sale. This is whatever inventory you have in your warehouse and you can sell for that accounting period. And then with a physical count, this is conducted through a physical count. This is the ending inventory. You subtract that one, so the cost of goods sold here, the cost of goods available for sale, and the inventory, you subtract that, that would give you the cost of goods sold. So basically once you have this one here, the whole thing is this is the whole thing together is cost of goods available for sale. You subtract ending inventory and you end up with the cost of goods sold. Let's see how this is done. So on the first we need to make the journal entries. So on the basis of the sales invoice and receipt, this is again it's the same example, but now we are assuming that the companies are using a periodic inventory system. So how do we record the $3,800 purchase? Here, what is Sauk Stereo doing? They purchased $3,800 worth of inventory. So they purchased inventory for the value of $3,800. Sauk Stereo, under the periodic inventory system, would debit this to purchases and credit accounts payable because it was purchased on account. This is this is under the periodic inventory system. As you can remember, for the perpetual system, we debited inventory. Here, the company would debit the actual account, which is purchases directly. As for the freight costs, under the perpetual inventory system, Sauk Stereo, when they paid $150 in cash for freight charges, they debited inventory directly, and that was because the cost of inventory for them had increased. Under the periodic system, Sauk Stereo, who is the buyer, would debit freight in. This is the account is freight in account, and it is debited $150 and credited cash $150. As you remember, this is under the periodic system. Under the perpetual system, it was inventory rather than freight in. When we get to purchase returns and allowances, Sauk Stereo returned $300 of goods, and their liability, because they purchased it on account, their liability, accounts payable, had decreased. As a result, they debit accounts payable $300, and they credit purchase returns and allowances $300. This is different from the perpetual system, which directly credited inventory. Under perpetual system, Sauk Stereo would consider that their inventory has decreased. Here, the company is using purchase returns and allowances directly. Now, purchase discounts. This is again, here, this is the case where they paid within 10 days. As a result, they are entitled to a 2% discount. So, once again, the liability, accounts payable, was $3,500, and it was settled in its entirety, so it was paid. As a result, accounts payable is debited $3,500. Cash that Sauk Stereo actually paid was equal to $3,500 minus the discount, which was equal to 70, and that means that the cash that was paid was $3,430. As a result, Sauk Stereo will credit purchase discount 70 and cash 3,430. On the other hand, under the perpetual system, they had credited inventory the $70 rather than purchase discount. So this is under the periodic system. This one is under the perpetual system. Now we get to record the sales side of the sales side. Here again, we assume that PW Audio are using periodic inventory systems. Now, for the as you remember, under the perpetual system, we used to make two journal entries. The first journal entry was to recognize the revenue. The second one was to calculate the cost of goods sold and the changes in inventory, basically for the expenses. Because under the periodic system, the company will not be calculating the cost of goods sold after every sale. Instead, they will do an end of period physical inventory count. We only make the journal entry to recognize the revenue. So in this case it was sales on account, so accounts receivable was debited 3,800 and sales revenue was credited 3,800. We don't make an entry for the cost of goods sold. When we had sales returns and allowances, again, under the perpetual system, we made two journal entries. One of them was to account for the changes in the to record the sales returns and allowances, and the second one was to calculate the change in cost of goods sold and inventory. Here, under the periodic system, when Sauk Stereo returned $300, PW Audio Supply makes the following journal entry. They would debit sales returns and allowances 300 and credit accounts receivable 300. What they are saying is that they have this contra revenue account that was debited $300 and account receivable has decreased, so it was credited $300. Now, if Sauk Stereo, the buyer, pays their debt within the discount period, they will be entitled to a 2% cash discount. As a result, PW Audio will be receiving cash 3,430, but so they will debit cash 3,430, and then the $70 difference, it is debited to sales discounts. At the same time, they will credit accounts receivable 3,500 to settle the debt of Sauk Stereo, the original debt from Sauk Stereo. That was for the net sales, 3,800 minus 300 returns. As a result, they credit accounts receivable to decrease them. This table here summarizes the differences between the perpetual system and the periodic system for the purchases side. Under the perpetual system, we used to debit and credit inventory. So we used to, for the when you purchase new merchandise on credit, you would debit inventory and credit accounts receivable. For the periodic inventory system, you debit purchases. And then here we debited inventory for the freight because it was added to the cost of the inventory. Under the periodic system, you debit freight and expense. When goods were returned, we credited inventory under the perpetual system, but under the periodic system, purchase returns and allowances was used instead of inventory. And same thing, purchase discount was used instead of inventory for the purchase discount. Now this was for the purchases side of the difference between periodic and perpetual systems. If we look at the sales side, they are basically the same. So the first journal entry is always the same. This one and this one are the same. The difference here is that the second one, which we used to enter under the perpetual system, we don't enter it for the periodic system. And the same thing is when we have when the buyer returns some goods. Once again, we don't make any different second entry to account for the change in inventory and cost of goods sold, because the company will be conducting a physical count at the end of the accounting period. Whereas the first transaction, which was sales returns and allowances, was debited, and when we credited accounts receivable, this one is also the same for both systems. As you can see, for the sales side of it, it's always the second one, the second journal entry is not entered. So journal entry 2 is not used. Same thing here, journal entry 2, we don't enter it, we don't make the second journal entry for the periodic inventory system. For the discount, it's the same entry for both systems. That concludes this chapter.